So up till now, what we discussed, what is normally accounting, recording of transactions, and then summarizing those transactions in assets, liability, income, expenditure, so that the users can take informed decisions. So accounting has two elements, recording and then summarizing. Once the recording and summarizing done, we will be getting financial statements. Those financial statements includes generally 5 things. In a different industry, regulatory, maybe other statements are also required. What is the difference between financial accounting and management accounting? External, internal, summarized, more detailed, required by law, not required by law, generally prepared annually, generally monthly or quarterly. Then it is based on accounting standards. It is not based on any standard. It is the way it is required. It is only the past information. It is past, present and future information. All are required. All are incorporated into management accounting. Can the business run without management accounting? Impossible. Can the business run without financial accounting? Impossible. Both are required for running and growth of the business. ACCA focus on financial accounting more and more. CIMA focus on management accounting more and more. But ACCA covers management accounting in detail. CIMA covers financial accounting in detail. And any commerce course covers financial and management accounting in detail. Now, as I said, recording of transactions in my organization, recording of transactions in Reliance will not be same. Even though in my case also there is tuition fee, sale, cost, purchases and everything. But the volume of transactions in Saraf Academy and the volume of transaction in Reliance, non-comparable. The organization need to set the system so that they can record all the daily transactions on up-to-date basis in a proper way. In my organization, 2 accountants are required. In Reliance, 1,000 accountants are required. Because the volume of transaction is such large, even though there is automation system, there is technology which they are using, IT system for recording transactions, but still so many employees are required. So there are many types of business entity which will decide the recording of the transactions. A business entity is an organization that regularly enters into transactions. We are entering into transactions. Why? So that we provide a reward in measurable monetary terms. We should be able to provide reward to me and my wife, to my employees in the form of salary bonus, to all of you. The reward is passing the exam, giving the exam. An organization is doing the transactions to give reward to all the persons who are engaged with the organizations. It is evident from everyday life that there are different types of business entity. What is less clear is that their organization legal structure. Individual, proprietorship, partnership, company, private, public, so many are. But their accounting requirements may differ. Maybe their legal status depends upon different law, but their accounting requirement also differ depending upon volume. Generally, in BT, we discuss so many types of business entities in the initial chapter only. Somebody will say that, sir, I have not studied BT. No tension. When we study at that time, we will study. But here we are discussing in basic level, there are 3 types of business entities. Sole trader, partnership, limited liability companies. Sole trader. A person is doing business in his own name. Suppose I am doing business, not Saraf Academy, Prakash Saraf in the name of Prakash Saraf. I am doing business as a sole proprietor. It's still me. And the business is different. Because whatever money I will be giving to the business as a proprietor, that is capital in the business. For the business, it is a liability. The business is going to return this money to me. But in legal language, in legal parlance, Prakash Saraf and the business of Prakash Saraf is same. There is no separate entity. In accounting language, whether it's a sole proprietor, then also they are separate entity. But in legal language, income tax or any law, a sole proprietor and the sole proprietor business are not separate. The sole proprietor and the sole proprietor business is one. But in accounting language, recording of transaction, summarizing transaction, the proprietor and the proprietor business are separate. In the proprietor, Why in the law, not in accounts, why in law proprietor and proprietor business is not separate? If in Saraf Academy there is losses, Saraf Academy is a separate company. I am the shareholder. If there is any losses and the Saraf Academy is not able to pay those losses, I am not personally liable. My personal assets inside my house is not liable for the liability of my company. But in case of proprietorship business, the business liability, the proprietor is personally liable. The personal assets of the proprietor can be used for meeting the obligation of the business. So in legal language, sole proprietor and the proprietor business is not separate. In account separate. But in legal and in accounting both, in case of company, the shareholders and the company are separate. A sole trader, this is the most simplest form of business entity, where a business is owned and operated by one individual, because for that reason sole. With this form of entity, there is no distinction in law between owner and the business. But in accounts, owner and business are separate. Because we record capital as liability in business books. We record capital as a liability in business books. There are so many sole trader business all over the world, whether it's India, whether it's UK, whether it's US, anywhere. सारी जगह ही है. It is not essential that to do business you need to form a company only. You can do business in your own name. So this is the simplest form of business where the regulatory requirements are least, where a business is owned and operated by one individual. With this form of entity, there is no distinction in law between owner and the business. The importance of this language is that if in the business there are losses and the business is not able to meet up their obligation, then the businessman is personally liable for paying the business liability. That means in the legal language, business and businessman is not separate. But in the books of accounts, they are separate. The businessman is separate and the business is separate. In the business, whatever the businessman has given to the business, that will be capital as a liability. In a small, I will say sole proprietor, sole trader business, the volume of transactions are less. The recording may not be done daily, maybe weekly, maybe monthly, depending upon requirement. But summary will be prepared in a business also, in a sole trader also. But the recording of transactions are more uneven. Partnership, just like sole trader. But in a partnership, more than one person is the owner. Maybe 2, 3, 5, 10, 20, whatever. Partnership, this is similar to a sole trader, in that the owner of the partnership share all the profits, but have unlimited liability for the losses and debts of the business. Suppose there is a partnership business in which me and you all are in the partnership. We are doing business as a partnership. Now, we all 10 persons are responsible for the partnership. If in the partnership there are losses or the partnership is not able to pay their liability, their obligations, we all 10 persons are responsible for meeting the obligation of partnership. So in legal language, even in partnership also, businessman, partners and business is not separate. But in books of accounts, they are separate. In a partnership, if suppose there is a loss, you all are not able to meet up that loss, you all not, I will need to pay the entire loss. It's not that my share in the partnership is say 5%. Then I will be bearing the loss only 5% obligation. I am personally liable for entire 100% of the loss. So a partnership, all partners, all their personal assets will be used, will be required to set off the liability of the partnership. So why anybody construct a big company? So that personal assets are not liable. In Saraf Academy, my personal assets are not liable for the Saraf Academy liability or anything. But in case of sole proprietorship and partnership, the sole proprietor and all the partners are personally, individually liable for all the obligations of the business. because there is no separate entity. But in the books of accounts, separate entity is there. Company, limited liability, whether it's a public, whether it's a private. Mine is a private company. The shareholder is Prakash Saraf, Vidisha Saraf. But Reliance Industries and all that is a public company. In a public listed company, the general public is the shareholder. But whether it's a Saraf Academy, whether it's a public limited company, any company, the shareholders are liable to the value of the shares. I have 5,000 shares of Saraf Academy, one share value 10. I have already paid 5,000 into 10, 50,000, 13, 14 years back. So if there is any loss in Saraf Academy, I am not personally liable because the shares are already fully paid up. My liability in the company will be there based on the shares value. If the shares are not fully paid up, then whatever amount on shares not paid up, for that I will be liable. But if they are fully paid up, I am not liable for anything. That is limited liability. In business, sole proprietorship, partnership, you can't say limited liability. But in company, limited liability. This type of business entity differs from sole trader and partnership. Limited liability companies are established as separate legal entity, which make them distinct from owners. So in a company, Prakash Saraf, Saraf Academy are separate, legal-wise, accounting-wise. But in sole proprietorship partnership, legal-wise, Prakash Saraf and Prakash Saraf business is not separate. In accounting books, they are separate. But legality, the difference is only there in case of company. In case of other forms of business, the owner and the business are one. They are not separate. So if there is any loss in the business, then the owners need to compensate the entire loss. But in case of company, the owners are not responsible for a single loss of the company. If the shares which are taken by them are fully paid up, the company has taken entire money from the shareholders, then there is no liability of the shareholder. Now recently in last 7-8 years, there are different forms of business developed. One-man company. One-man company was not allowed earlier. It is in Indian Companies Act, other laws, one-man company allowed. There is unlimited liability company. वैसा भी है. So there are different structures developed which are not here, because then in that case we need to go very regulatory thing. And regulatory thing I am also not expert, because company law, Indian company law I have not studied for 20 plus years. Because I am not a specialist in regulatory matter. So that is not our cup of tea. In international courses, they are not testing regulation of any country. They are testing non-regulatory area, तो मैं उसमें नहीं जा रहा हूं. The transactions recording, summarizing of the transactions depends upon the nature of the business entity. Whether it's a sole trader, whether it's a partnership, whether it's a limited liability company. Now to record the transactions and to summarize, there should be principles, guidelines, boundary, framework. So for international accounting standards, there is a framework developed by International Accounting Standard Board. Boundary, guidelines, that how the transactions will be recorded, how they will be summarized. That guidelines is called framework. The framework of accounting. The framework of international accounting standards. This framework is regularly revised. I don't remember. First of all, this framework was prepared in 2000. That means around 22 years back. Then the body changed the framework in 2010. Then again the body changed the framework in 2018. After 18, already 4 or 5 years are over. And I am hearing that the body changing the framework again. Why the changes are required? Whatever type of transactions happening today, after 2-3 years, 4 or 5 years, there are so many different types of transactions arises. You will say, can you give one example? One example, derivative transaction. Derivative means what? We don't have in the syllabus, just extra knowledge. Because it is difficult to teach derivative at this level. But just simple language. Suppose I will say that in the share market, the share prices are going down. Today the share market is down. In the share market, the share prices are going down. but I am thinking that the share market will go up. So I should buy shares, because when the share market will go up, prices will be increasing. But if the share market, in place of going up, started going down further, then I will lose. To safeguard myself, in place of buying shares, I will be buying shares future. Shares future. Shares future means I am not buying now. I am entering into contract that I will buy the share in future. Shares future means you are entering into a contract to buy shares in future. If you enter into such type of contract, it is called derivative. These derivative transactions started in the whole world in the year around 2007-8. At that time when they started, the volume was very small. Now in 2022, the volume is magnificent. The level of volume you can't imagine. So earlier there were some rules developed for recording, summarizing derivative transactions. But then later on, the accounting body realized that those rules are not appropriate. They are wrong. They are not correct. So the body realized that the rules should be rectified. The rules should not be followed. The rules should be changed. Even still, if you see me, if you ask me, when I teach at highest level derivative transactions and all that, then I found that there are so many mistakes are there which need to be rectified. So the problem is that the framework cannot be fixed. But presently the framework which is applicable is 2018 framework. After 2018, new framework is not published. The framework, if you do Google search, framework by International Accounting Standard Board, the framework is around 100 to 150 pages write-up in a font size 11 to 12. That framework is there in our lowest level, that is in financial accounting, middle level, highest level. Every level they will be testing framework. To understand framework, because it is pure theory, the student need to understand first of all basic accounting, how to record sales, how to record purchases, how to record other revenue transactions, how to record purchase of assets, how to record sale of assets, how to record loan taken, how to record investment done, so many things. When we understand the transactions, we will be able to understand the framework much better way automatically. We say framework is Bible, Gita, Quran, whatever you say. For whatever religion you belong to, you can say framework means Bible, Quran, Gita, or whatever you say. That means every type of transaction, how it will be recorded, is written in the framework. And summarizing of those transactions is also written in the framework. But then the framework is not writing every transaction, sale, how you will record. The framework is prepared by considering certain principles, notions, certain understanding. And those understanding we need to apply while recording transactions. Not that if somebody reads the framework, Bible, then the others, they don't need to study accounting, recording and summarize. They don't know. Actually, first of all, when you understand the recording of transaction, you will automatically understand framework. Now, actually, in the International Accounting Standard, there is a framework. And on the basis of framework, the International Accounting Standards were developed. There are 41 International Accounting Standards. And there is IFRS, International Financial Reporting Standards, which are for the time being 16. What is this? Based on the framework, for recording different transactions, separate accounting standards has been made. Those accounting standards are getting prepared since 1975. And they are going to celebrate in 2025 50 years. 50 साल से बना रहे हैं, 50 years से. Those standards they are making for 50 odd years. Those standards are regularly changing because of the change in the framework. Now, up till 2000, the accounting standards were named as International Accounting Standards. After 2000, the name has been changed and they are named as International Financial Reporting Standards. For recording financial transactions, it is standards. So before 2000, it was accounting standard. After 2000, in 21st century, it is International Financial Reporting Standards. Sometimes the old standards are deleted. There are many old standards which are deleted, against which the body has introduced the International Financial Reporting Standards. In our syllabus, financial accounting, some 5-6 international accounting standards and IFRS are there. When you go in further level, all IS, IFRS will be coming. Now, you will find that sometimes the framework is saying something else, but international accounting standard or IFRS is saying something else, contradiction. Whereas it should not be, because as per the framework, whatever is the Bible, that should be there in the accounting standard also, because accounting standard is prepared based on this basis only, based on this framework. But you will find many places the differences are there. Then the accounting body is saying that the framework is not relevant. Whatever is written in accounting standard, that is applicable. Somebody will say that why the difference is there? There is some accounting standard which was developed before 2018 revised framework, and they are still not yet changed. Or maybe there is a new framework in 2018 came, but when the accounting standard changed, it was not able to incorporate fully. You will say why? It is not 2 plus 2, 4. It is very debatable point. Because somewhere when the confusion arises, because accounts is not science. Accounts is an art. Accounts is not pure science. You will find that for a particular transactions, there are different ways of accounting it. Which method is most favorable? It's very difficult to say. Which method is most favorable, most dynamic, most relevant is difficult to say. It is a debatable point. So sometimes the debate are going on, not resolved. So still the accounting standard is different and the framework is saying something else. Then the accounting body of the world is saying that you need to follow accounting standard, not the framework. The framework is not relevant for preparing accounting records, recording the transactions and summarizing. Accounting standards are relevant. But 95% framework and accounting standards are on the same line. Whatever is said in the framework, that same thing is there in the accounting standard. We say as a common simple language, framework or Bible. Based on the Bible, the accounting standards are prepared. Some differences may remain there. Those differences will be followed based on accounting standard, not based on framework. Relating to this framework, IAS, IFRS, International Accounting Body, Advisory Board and all that, there is some write-up which I am not covering now. I will cover in the next class in a separate story which is relating with this regulatory thing. For the time being, my objective is not to cover regulatory thing. One of the most important document underpinning preparation of financial statement is Conceptual Framework, which was prepared by the International Accounting Standard Board. Discussion of the regulatory bodies. The framework presents the main ideas, concepts, principles, IFRS standards and the financial statements. The framework says ideas, concepts, principles, IFRS standards and all that. We can say that the framework includes mainly three things. What is the objective of financial reporting? What is the objective of preparing PL account, balance sheet, cash flow, purpose kya, objective kya? What is the characteristics of preparing them? That means once we prepare PL account, balance sheet and all that, then what characteristics they should have? They should have those characteristics, then only they will be beneficial. To prepare financial statement, to apply IFRS, how you will define different assets, liability, income, expenditure, how you will recognize them, how you will measure them, at what value, how you will record them. The framework says about objective of preparing financial statement. The framework says about the financial statement should have these characteristics. The framework says about every item, everything. the definition, their recording, their measurement, how it, at what value they will be recorded, the framework says about that. But this is all things, objective characteristics, recording and all that is there in framework, is there in international accounting standard IFRS also. If there is a contradiction between the framework and the IAS, then the accounting standard will prevail, framework will not prevail. Even though framework is a Bible. We can say that if we go into slightly deep, the objective of financial reporting, characteristics and definition. So first of all, objective. What is the, as I am saying since the beginning of this class, what is the purpose of financial statement? Objective क्या है? कि if I am a customer, if I am a shareholder, if I am a financer, if I am a supplier, if I am a general public, by looking at the financials of the company, I will be able to take informed decisions. What decision? If I am a shareholder, whether I should invest or not. If I am a financer, whether I should give loan to the company or not. If I am a supplier, whether I should give goods and services to the company or not. If I am a customer, whether I should buy goods and services from the company or not. That means the objective of financial statement is what? The users should be able to get the information which they require. That is the purpose, that is the objective of financial reporting. The main objective of financial objective is to provide financial information about reporting entity to users of the financial statement that is useful in making decisions about providing resources to the entity as well as other financial decisions. जो भी यूजर्स है, आप किसी को भी यूजर बोल सकते हैं, वो यूजर को अपना डिसीजन लेने में तकलीफ ना हो, वो यूजर अपना डिसीजन सही से ले पाए, वो पर्पस है फाइनेंशियल, यू कैन से फ्रेमवर्क का ऑब्जेक्टिव. In order to provide useful information to stakeholders, shareholders, suppliers, financiers, everybody is treated as stakeholders. The financial statement must fairly present the financial position. Users can take correct decision, proper decision when the financial statement are prepared in a proper way, without any bias. Irregularities are not there, faults are not there, problems are not there. While these have never been formally defined, एक्चुअली इसको डिफाइन किया नहीं जा सकता. व्हाट इज रॉन्ग और राइट इन अकाउंटिंग इट्स वेरी डिफिकल्ट टू सी. यू विल से सर ऐसा क्यों बोल रहे हैं? जब धीरे धीरे आगे बढ़ेंगे समझ में आएगा. एज आई सेड, दिस फ्रेमवर्क वी कैन अंडरस्टैंड वंस वी अंडरस्टैंड रिकॉर्डिंग ऑफ ट्रांजेक्शंस, और ज्यादा समझ में आएगा. बट फिर भी अ बेसिक इंट्रोडक्शन एट द बिगिनिंग embodies the concept that the financial statements comply with laws and regulations. जो भी आप पीएल अकाउंट बैलेंस शीट बनाओगे, they should follow laws and regulations. They should follow the relevant accounting standards, and they should have the characteristics which is required. Users, investors, those who are investing in the company, customers, you are the customers, suppliers, computer provider, laptop provider, lenders, those who are giving loan to the company, government is interested whether the company is paying proper taxes, whether the company is generating proper revenue, contributing to the growth of the economy. Competitor want to analyze your financial so that they can compete with you in better way. Public, क्या हम लोग सोशल बेनिफिट सोसाइटी के ऊपर देख पाएंगे, whether we can think about environment or not. Employees, whether they will get bonus, commission, growth. Management to take decisions, they required financials or investors. You can add other. सबको इंफॉर्मेशन चाहिए. Now, in the framework, for the time being, we are covering basically elements. Elements matlab, in a body, I have nose, I have eyes, I have ear, and so many things. These are the elements of the human body. Similarly, in the financial statement, what are the elements? Financial statement means PL account, balance sheet, cash flow, and all that. What are the elements? We say that the elements are assets, liability, income, expenditure, and equity. You will say expenditure, assets or liability से ही निकलेगा. So expenditure and income are part of assets and liability. So if anybody understand income, expenditure, assets, liability, equity, they can understand like a body. You understand in the body every element. Similarly, in the financial statement, whether it's PL account, whether it's balance sheet, whether it's cash flow, whether it's equity, notes to accounts, that include details of assets, liability, income, expenditure, and equity. So we say that in financial statement there are 5 elements. In order to appropriate report the financial performance and position, the financial statement have 5 key elements. In the PL account, income expenses, in the balance sheet, statement of position, assets, liability, capital. What is assets? Please concentrate on the definition. Not that comma full stop, but understanding. A present economic resource controlled by the entity as a result of past event. A present, I am underlining this, economic resource, I am underlining this, controlled by the entity, I am underlining this, as a result of past events, I am underlining this. Basically, if you forget about definition, can I say that for Saraf Academy, this computer laptop is an asset? Can I say that for Saraf Academy, this property where I am taking the class, this is an asset? Can I say that for Saraf Academy, the furniture, table, chair and all that which I am using for giving the class is an asset? Can I say that for Saraf Academy, this camera is an asset? Can I say that for Saraf Academy, whatever the notes and all that I am using are an asset? Can I say? Everybody. आप definition भूल जाइए. Can I say that land, building, plant, machinery, property, computer, laptop, furniture, fixture, camera are all assets of Saraf Academy? Can I say? Everybody will say yes. Now these things you go into the definition. Present. Presently I have this computer, I have this laptop, another laptop, camera, all are there. Presently there. It is not future, it is presently there. Economic resource. Economic means by using these assets, I am going to conduct my economic activity. What is economic activity? Providing training classes, getting tuition fees. Every business is doing some economic activity. Not only profit making. Not for profit oriented organization are doing business. Economic activity sabhi koi karte hain. Everybody is doing economic activity. There is nobody who is not doing economic activity in the world. You understand? Everybody is doing economic activity. What I mean to say that the assets are already at present. They are used in economic activity for production, for marketing, for distribution, whatever. They are controlled. मेरे को ये कंप्यूटर कैसे यूज करना है, कौन से बैच में यूज करना है, फुल कंट्रोल ओवर द कंपनी एज अ रिजल्ट ऑफ पास्ट इवेंट. क्यों ये कर पा रहे हैं? बिकॉज आई परचेज दिस कंप्यूटर इन द पास्ट. यू डिड समथिंग इन द पास्ट. बिकॉज ऑफ यू हैव अ प्रेजेंट एसेट. That asset is used in the economic activities of the business, and whatever economic activity you will be doing is fully controlled by you, then it is called an asset. तो फिर asset कौन सा नहीं हुआ? Which is not an asset? Present, if it is not presently there. मैं एक कंप्यूटर खरीदूंगा. If it is not used in economic activity, it is not an asset. In my business activity, if I am not using something, that is not an asset. You will say, sir, example, suppose this computer fell from desk. This computer fell from desk and I need to replace the computer. So old one I replaced, the new one I purchased. अब ये जो पुराना वाला है, I am not using in the classes. So now it is not an asset as per economic resource because it is not going to use in the economic activity. मैं क्या करूंगा? सल्टा दूंगा. When any asset is not going to give me economic benefit, not going to help me in economic activity, I will finish off. Control. If I am not the owner of something, I cannot control. You can control something if you are owner. Owner होने के लिए it is not that legal agreement होना चाहिए. Owner maybe without legal agreement is also possible. How? Suppose you are taking an asset on lease. Lease is 10 years. Till 10 years you can use the asset the way you like. Now, in legal term, you are not the owner, you are the lessee. But in accounting term, you are controlling. In accounting term, it is a present asset used in economic activity. You are controlling, you will be recording the asset. A present economic resource controlled by the entity as a result of past event. This is written, comma, full stop. as per the technical language of the framework. Liability, a present obligation of the entity. A present obligation of the entity. Like present, it is also present. I purchased computer in the past, I have not yet paid to the supplier. So it is a present obligation, means I need to pay. I need to give economic benefit. Payment I will be doing in cash or any other asset. Suppose I need to pay. In place of giving cash, I am giving shares of Reliance Industries. Chalega. I am giving another asset. A present obligation of the entity to transfer an economic resource. For present obligation, you need to give your economic assets, then only your liability will be settled. That is called a liability. Capital, a special kind of liability due to the owners and is the residual interest in the assets of the entity after deducting its liabilities. Please focus on the definition. Suppose in Saraf Academy, land, building, computer, laptop, camera, furniture, fixture, suppose all are 5 crore. Suppose. But the liabilities which I need to pay to the supplier, bankers, creditors or anybody, it's say 3 crore. So 5 crore minus 3 crore, 2 crore is equity, which is actually what? Money given by the owner. So you will say that, sir, Prakash Saraf, Vidisha Saraf has given 2 crore. No. We have given initially the capital, then whatever the profit generated by the business, we have not taken that profit. That profit is still invested in the business, that is also equity. A special kind of liability due to the owners and is the residual interest in the company. Assets minus liability. In the assets of the entity, we can also say net assets. We can also say net assets. That means after deducting all liabilities. In every organization, whether it's an individual, whether it's a partnership, whether it's a company, when you add all the assets of the business minus all the liabilities, then there will be surplus coming. That surplus is in individual, sole proprietorship, partnership, is capital. In case of company, it is equity. Equity is the net assets. Equity is the residual interest on the assets of the company. Income. Increase in assets, decrease in liability, result in increase in equity, other than those relating to contribution from the owners. Again, please focus on definition. Somebody called me many times, sir, increase in assets, how it is an income? Suppose I am selling goods on credit. मैंने goods उधारी में बेचा. Now the goods I purchased for 1,000, I sold for 1,200. Assets was 1,000, inventory. But now when the goods are sold, assets, inventory gone, but the receivable becomes another assets, 1,200. So assets kitna se increase hua? In place of 1,000, now it is 1,200, 200 more. That is an income. Increase in assets is an income, decrease in liability. Decrease in liability, why it is an income? Suppose I will say that you have a creditor, you have payable 1,000, you are paying him 1,000. No income. Because it is not a decrease, because when your liability decreases, your assets also decreases. You are paying to a creditor 1,000 due, so creditor liability goes down by 1,000, assets, cash goes down by 1,000. But suppose to a liability in place of 1,000 you are paying 900. For a liability in place of 1,000 you are paying 900. 1,000 के बदले you are paying 900. Then आप 1,000 के बदले 900 pay कर रहे हो. Then what? So liability is reducing by 1,000, asset is reducing by 900. Net me, liability is decreasing by 100 more. That is an income. Because you are getting discount, that is an income. Increase in assets is an income. Decrease in liability is an income. Results in increase in equity. Ultimately, when asset increase, liability decrease, net assets increase, equity increase. But other than the relating to contribution, suppose in Saraf Academy further shares issued, and me and my wife purchase those further shares, that is not income. If the owner are giving further money to the business, then it is not an income. But other than the owners not giving further money to the business, increase in assets, decrease in liability is income. Similarly, expenditure, decrease in assets. Decrease in assets, you can say depreciation. Assets value goes down. Depreciation you deduct, you consider as an expense. Increase in liability, I am purchasing goods on credit. So when I am purchasing goods on credit, purchase in expense, increase in liability is an expense, result in decrease in equity. Other than relating to distribution, suppose we are giving dividend to shareholders, suppose we are giving drawings, that drawings is also decrease in equity, but that is not expense. That is the profit distributed to the shareholders. Decrease in assets, increase in liability is expense. Increase in assets, decrease in liability is income. But other than the direct changes in equity, that is not an income or expense. Income and expense are recorded in PL account. Assets, liability and equity are recorded in balance sheet. These are all called elements of the financial statement. Elements. Assets, liability, income, expenditure and equity. You will say cash is a part of assets only. Notes to accounts is explanation on these 5 things only. But the elements, like in body we have so many things. Similarly in balance sheet, I mean to say in statement of financial position, financial statement, there are 5 elements. Assets, liability, equity, income, expense. Then comes